Having an S corporation can help you save thousands of dollars in taxes in 2024, but not using it correctly not only can cost you money, but it can lead to IRS audits and major IRS penalties. So today, I'm going to be talking about the biggest mistakes that we see clients make with their S corporations and how you can avoid them. And make sure you stay to the end, because I'm going to be showing you all a secret strategy on how our millionaire clients use S Corp holding companies to save thousands more on taxes. All that plus more in today's episode. What's up, family? Welcome back to another episode of Tax-Free Living. I'm your host, Carter Cofield, and I have a simple goal. I want to help entrepreneurs like you live tax-free. Now, today's episode is going to be amazing because we're going to be talking about S corporations. And the reason I decided to talk about this episode is because something that recently happened in our firm. So we recently had a new client hire us, and they came in super excited because, like, dude, I've been following you for years. I couldn't wait to work with you, and I finally had the opportunity. I've been listening to your stuff. We have our S Corp set up. We've been doing everything right. Can you look over our tax returns and make sure that everything is good for last year? And can you help us going into next year? So I was excited too, because I'm like, okay, cool. And when we looked over the return, kind of paused. Because as we reviewed it, yes, they had an S corporation, but they were making some major mistakes with how they were operating their S corporation. And the way they were operating their S corporation, not only did it increase their tax liability, but it also left them open to a potential audit. So we had to give them the unfortunate news about how they were operating incorrectly, and then we had to start the process of fixing it for the previous year and making sure they operated properly going forward. So this made me want to do an episode just walking you all through the mistakes that we see a lot of our clients make and how you all can avoid them. And we'll be going through some of those mistakes today during today's episode. So mistake number one is they didn't have any payroll set up. And not having payroll set up via having an S Corp is a major red flag. So let's go through an example and show you why payroll with the S Corp is so important. So if we go through an example, and let's say we have an LLC over here and an S Corp over here, right? So if we make $100,000 in both of these companies, right, we're going to have to pay federal taxes on this money. We're going to have to pay state taxes on this money. And we're also going to have to pay self-employment taxes on this money. Self-employment taxes is 15.3%. So in the LLC example, they would have to pay taxes of $15,300 in self-employment taxes, aka FICA taxes. Now, the beauty of having an S corporation, and one of the reasons why we want to have one, is because S corps help us save on self-employment taxes. And the beauty about S corps is you don't have to pay FICA taxes on all the money. You simply only have to pay FICA taxes on the salary that you pay yourself. So let's say that we paid ourselves a salary of $30,000. Okay, this is our salary. Okay, so we would have to pay FICA taxes on this $30,000, which would bring us to a FICA tax bill of $30,000 times 15.3% brings us to times 0.153. There we go. A self-employment tax bill of $4,590. Now, the amazing part about this is having an S Corp versus having an LLC, we're going to save over $10,710 in self-employment taxes. Great. That's the point of having an S Corp. And some of you all are probably thinking, well, Carter, if we only have to pay self-employment taxes on the salary we pay ourselves, why don't we just not pay ourselves a salary at all? Because if we don't pay ourselves a salary at all, then 100% of the money avoids self-employment taxes. And this was the same thing that our client thought to themselves. It was like, well, Carter, I heard your videos. You only have to pay FICA taxes on the money that you pay yourself, on the salary that you pay yourself from your S corporation. So we decided not to pay ourselves a salary at all. You can't do that because the IRS knows that as well. That's why the IRS comes up with something called a reason. My bad, y'all. I'm spelling this off today. A reasonable salary. Okay? So the IRS requires you to pay yourself a reasonable salary from your S corporation. And the minimum reasonable salary that we advise our clients to pay themselves, minimum, is 30% of the net income from their business. If you do not pay yourself a reasonable salary, that is essentially tax evasion, because you're not paying yourself a salary at all and you're completely avoiding self-employment taxes. And the IRS has that in the code that you can't do that. So one of the easiest ways to get audited having an S corporation is not having a salary or officer's compensation on your 1120S. Okay? Like, it is almost guaranteed that your tax return will get flagged if you don't have a balance or a salary amount in the officer's compensation line on your 1120S. And this is one of the biggest mistakes I see S corporation owners make. Okay, so this was the first mistake I saw on their tax return. Unfortunately, it wasn't the last. What's up, family? Are you ready to make more in 2024? I'm talking make more money, pay less taxes, and get access to more capital. If so, I want you to join our 100% free masterclass where we're going to be teaching you all of these strategies so you can keep more money in your pocket and you can make your money make money for you. So if you want to be a part of this amazing free class, all you have to do is click the link below and save your spot. The problem is we only have 50 seats. So I will pause this episode, go register, and come back to it after so that you can save your seat for this masterclass. Other than that, I'll see you inside the class. Let's get back to the episode. Now, the second thing that I noticed is they had 3 1120S tax returns, which means they had 3 different S corporations. And I asked them, I said, well, why do you have so many S corps? They said, well, we have 3 different businesses, and all of our businesses are doing over $50,000 in net income. And I didn't want to pay self-employment taxes, so I made them all S corps, and because that's what I thought I should do. And there was nothing inherently wrong with this. It just made things more complicated than it needed to be, right? It just made things more complicated than what it needed to be. And let me explain what I meant by that, okay? Let me go back to whiteboard. When you have multiple S corporations, that means you're going to have multiple tax returns, you're going to have multiple W-2s, and you're going to have multiple accounts that need payroll set up. So think about this. If you have 3 different S corps, you have to have 3 different payrolls set up because you have to run payroll for each S corporation. So you have 3 different payroll accounts, which can get expensive. You have to have 3 different 1120S tax returns. 1120S tax returns at minimum with a good accounting firm is going to cost $1,500 per return. And you got to pay that 3 times. And last but not least, you have to have you have to file 3 different W-2s because each S corp needs to run payroll for a minimum of 30% of the net income from the business. So you got to have 3 different W-2s, 3 different payroll accounts, and 3 different tax returns. Talk about complexity and expensive costs. So they said, well, Carter, what do you recommend? I'm glad you asked. This is where we take advantage of something called a S corporation holding company. Okay? A S corp holding company. Now, in my opinion, you should only have 1 S corp in your life. Okay? Just like you're supposed to have one, you supposed to have one love of your life. You're going to have one S Corp in your life, okay? And this S Corp is going to be an S Corp holding company, okay? And this company's job is to hold the income from all of your other business ventures. So now that you have this S Corp holding company, let's say that you have a business over here that you do consulting. Let's say you have a business over here where you do car rentals. I'm gonna just specifically say STR, so short-term car rentals. And then let's say you have a business over here where you have a media company where you're doing all your podcasts and you're getting brand deals and things like that. So all of these companies are going to be LLCs. They're not going to be S Corps. All of these companies are going to be LLCs, and they're going to be owned 100% owned by your S Corp holding company. Okay? The reason that we want to do this is, number one, it doesn't matter how much money these other businesses make. So this business can do $100,000 in net income. This business could do $200,000 in net income. And this business can do $300,000 in net income. These will never need to be upgraded to S corporations because all of the money from these different businesses are going to flow down to your S Corp holding company. So now your S Corp holding company has $600,000 in income, and this S Corp holding company is going to be the one that has all the income. So you never have to worry about upgrading your other entities to save on self-employment taxes by doing it this way. The second benefit of this is the asset protection you get. So you still get asset protection from each entity from itself. So your consulting LLC has asset protection from your rental LLC. Your rental LLC has asset protection from your media LLC. And all of these individual LLCs have asset protection from your S corporation. So if somebody trips and falls and breaks an ankle here, they can only sue you for what's inside of the rental LLC. These other LLCs are protected. That's benefit number 2. Benefit number 3, one of my favorite. Because all of the money from the other LLCs flow down to the S corporation, all of the money is going to be recognized on the S corp level. So what does that mean? That means you now only have to file one tax return. Okay? That means you now only have to file one 1120S tax return because the consulting LLC doesn't need a tax return. The rental LLC doesn't need a tax return. The media LLC doesn't need a tax return because all the money from those companies is flowing down to the holding company, which is going to reflect all the income anyway. So now you went from having 3 different tax returns to having one. Talk about saving money and gaining ease and flexibility. That's the goal here. We want to save money and we want to save on complexity. And to make it even better, guess what? Because we only have one S corp, we only have to do one W-2. So now instead of having 3 W-2s, you only have one W-2. And guess what? Instead of having 3 different payroll softwares for 3 different S corps, now you only have to have one payroll software and one payroll W-2. So by structuring your company using this S Corp holding company, you're going to gain ease of use. You're going to save money on tax returns. You're going to save money on payroll providers. And you're going to gain the ease of only having to compute one W-2 versus 3 W-2s. Right? And then all this is going to flow down to your 1040. And it's going to make everything nice, clean, and easy. So you can still have all of your business ventures, right? Because I want you to have different business ventures if you want. But now you only have to do one corporate tax return, one personal tax return, no matter how many businesses you have. And this S Corp can own other LLCs over here. The S Corp can own 50% of a partnership over here. And no matter how many different businesses you start, you still only have one S Corp. You still only have one tax return. You still only have one W-2. You still only have one payroll. And this is the goal that we want to be at. So with our example, we were able to, moving forward, restructure the client's businesses so that he only had one S Corp and his other business ventures were owned by that S Corp. And going forward, they're going to be able to save money on taxes, avoid audit risk, save money on payroll providers, and gain ease and ease of use and simpleness in their company structure. So if you need help setting this up, if you want somebody to overview your entity structure, all you got to do is reach out to us. But this is the goal. This is what we want to do, and this is how we want to structure our S Corps going forward so that we maximize our ease and minimize our taxes. If you like today's episode, please hit that subscribe button, hit that like button, and share this video with somebody that you know, because I can't tell you how many mistakes I see that's costing business owners thousands of dollars, because ignorance is not bliss. Ignorance is expensive, and I want to stop you from making mistakes. See you all next time.